All right, let's talk about cutting losers faster in this video today. Um, if you are a futures trader, how can we go about, protecting the capital, the money that we have in our broker account? Okay, and maybe even if you trade prop firms, this still applies in a sense because you can use it towards finding your way out of a trade quicker. All right, sooner than later, so that you're not blowing your account or challenge. All right, so. Let's take a look. I'm going to show you an example of a trade setup that was a sweet setup going to the downside. It was a supply trade that I marked up off of my 120 range chart. So if you're someone new to this video, or this channel, I should say, watch some of the videos on the channel. I have tons of great, valuable videos. I started this channel because I wanted to inspire other individuals that trade specifically supply and demand, but also just anyone out there that's a day trader, whether you're part-time or full-time. Okay, I talk about on this channel about ways to be able to grow a small account. I talk about the strategy and how I actually trade supply and demand with just using. It's all about finding high probability setups using confluence, or finding means of areas of confluence that will make the trade a higher probability setup. Okay. So I talk about the strategy across the channel, so lots of valuable content. I talk about also ways to actually, grow your money in your broker account, whether it's you're looking to make $200 a day or $1,000 a day. Ways to be able to do so even if you trade the micro futures and you're just starting off. Okay. I also talk about the things and are needed, the concepts that you must understand to put you in the driver's seat so you can educate yourself properly and being able to trade correctly. So let's take a look here at this setup that I'm going to show you. This was a supply setup. Now, market structure I always talk about is imperative. You have to understand what the market is doing, even on a higher base chart. And that's the reason why I like using higher base charts and using a top-down analysis. So basically using a higher base chart to give me or show me the direction of the market. That's all I need to know. It's like, which way is the market moving? And then I can look for my setups off of a lower base chart to confirm and get into a trade entry. So if I see the market pushing to the downside and it's constantly breaking structure to the downside, as you can see right here, okay, and all that is price or the market making lower lows and lower highs. When I see things of that nature taking place, I'm interested more so than looking for a supply setup. Okay, this is the VWAP, the volume weighted average price indicator. I don't use it to actually say, get into a trade. I don't do that. I trade supply and demand, and all that is finding areas or locating areas of aggressive selling and buying. And I'm going to show you again how you can go about cutting your trades quicker so that you can protect the funds, your capital, your money, and where you're not getting stopped out on a full stop. Okay, so it's a way to be able to get out of the trade and save some money, whether you're in drawdown or a slight bit of drawdown. The market's broke back above or below you at break even to get out before it actually hits your stop loss. So anyone that out there that is struggling, just kind of following structure of the market. I mean, you can see the market pushed up here, right? Then it broke structure, pulls back, breaks lower. Okay, you see that? Pulls back, still breaking structure here, pulls back, still breaking structure to the downside. That's a slight structure break to the downside. Pulls back again, breaking structure. So it's making these lower highs and lower low runs right here, right? Right here, the market is kind of moving sideways, all right, as you can see right here. And it did come up here and break this high where it broke structure, but it didn't continue pushing to the upside. It came up against an area of resistance right here, and then it turned back around and broke structure again. Came back up here, didn't break this high here, so it made a lower high, and it broke structure back then. Down to the downside. When I see things like this, where it's moving like this, and then it's kind of moving sideways, all right, I kind of wait this out, all right. I want to see it come down and break some area of structure below, meaning this major low right here, and then look for a pullback to actually go short. Now, we have to identify our key areas of supply zones to where the market could actually pull back at. Now, you see this structure break right here. Now, if I take this away, because I want to just show you something, when the market broke structure right below this blue arrow right here, If you look to see what happened, it broke right here. It pulls back. There is a aggressive selling right here, but also there is a supply area right here as well. Aggressive selling here. Let's look back up. Everywhere else has already been mitigated. So when we're looking for areas to get into a trade at and markup zones, I like to, and I'll talk about this, about high probability setups. Those are ones where the market is pulls back to a zone, and that zone is unmitigated. All that simply means is that the market hasn't tested that area yet. So it could have tested here, or it could have tested here. But it came back to this area right here. One thing you can also do, and this is the reason why I like using the volume profile, when the market pulls back to a key area, say a zone, you see how it's at this high volume area. Typically speaking, I like to take my trades slightly above the high volume area if I'm going short, and then below them if I'm looking for a long entry. So spread this out a little bit. The market pulls back to this zone. Now, when it pulls back to this unmitigated or untapped supply zone, I'm moving down from here just down to a lower base chart. That's all I'm doing. So let's move this arrow line back down. We'll move down to the 24 range, because this is a 120 range chart. I'll move down to a 24 range chart and look for a opportunity to get to the trade going short. But I want to show you an example of what could take place in light if the market kind of pull back to where to get out of the trade to cut the loss early. Now that we're on the 24 range chart, the market pulls back. We're in that zone off of the higher base chart, that green rectangle box that you saw on the other chart. So once I'm here, basically all I'm doing is looking for where the market wants to show me directional shift, meaning a reversal back to the downside. Okay, so we're bearish movement on the higher base chart, so I want to look for some bearish movement on the lower base chart. The market pulls back to the zone. When it breaks to the downside, it's breaking structure here. Okay, makes a low or high, it breaks structure right here. So it's showing me where it's made a low, lower high, low, lower high, and it's breaking through some area of structure right below here at 804, leaving behind the supply area. So I'm going to mark that zone up. So it's just looking for two means of supply areas, one off the higher base, one off the lower base. But on the lower base chart, I want to see a structure break moving in the same direction as the higher base to be able to get into a trade setup. So when it pulls back to that unmitigated, untapped zone on the lower base chart, now that supply zone, I'm looking to go short. All right. All I'm doing from that point there is looking for confirmation or rejection to get into a trade. I'm looking for the break and close of the candle. Boom, it goes down. It does pull back here. It's testing this area. Market makers love to do that. They know where, and they set up traps like this where they make aggressive runs real quick, and then they know the market will pull back. They know people will get into a trade. Retail traders will trade right here. The market will push up. They'll move the market down lower just to come back. See how it came back right above this high right here? That's the origination area where the supply zone was at to where it started selling off. Think about it. They're coming back here for a reason, because they want to stop traders out. They're going to capture your money. That's an area of liquidity that they want to run. So they know people and set up a trap for you to get into a trade going short just to come back and stop you out, and then do what? Push the market lower. That's how they move. That's how they're taking traders out of the market and collect the money at the same time. So that's why I always talk about in videos, place your stop a little bit above the area, a few points, okay, to give yourself some breathing room. Now, what I really want to show you is that about cutting losses. Let's say this setup here was a beautiful setup and everything panned out as far as, what we need to see, okay? Pulling back to a lower base chart, supply area at the breaking structure. Got a gap there. It breaks and closes below the candle. The market pushes lower. So if we get to the trade somewhere around 804, it comes down here into this low. This is liquidity resting right here around 791, okay? And you picked yourself up more than 10 points right there, okay? Now, let's say that it did this right here. Let's say that it came down 2 candles after the break and close of the candle. 1 candle, 2 candle. And then it turned back around. This is where people get shaken out of the market. They get scared and they jump out of the market. What I like to do is, if this happens to you, now you have to make the choice to get out or not. Your stop is resting back here at 813. Let's say the market comes back, okay? Grab this arrow line, and it breaks right above this first candle, okay? All right? After we are into the trade going short, it breaks below that. It breaks back above, not below, above that bearish candle to the downside. And then it comes up and it breaks above a second candle right here, or the top end of that wick right there. You can go ahead and close the trade if you want to protect, your funds, okay? Because if you got in somewhere, let's say 804, it comes back up here to 809, you maybe lost, 4 or 5 points. But you didn't get a full-on stop because your stop probably is rested on the back end up here at 813. But give yourself some room, so maybe 815. So you saved yourself, if you got out here at 809, you saved yourself 6 points worth of stop right there, okay? 6 points worth of money. So if we equate that here on the NASDAQ, that's $120 on those 6 points right there that you saved yourself from. That's $120 a contract that you saved yourself in your pocket, okay? Where you didn't take on a full hit. So you've cut your losses and able to keep $120 per contract. So that adds up real quick if you got multiple contracts on. So again, maybe if you got on an 804, the market comes back up, closes above this candle here at 809, or not above. It comes back and it starts closing. It's like it wants to close above or starts breaking back above 809.5. You can go ahead and get the trade. Your stop's probably going to be sitting up here and maybe at 15. But if you have it even sitting here at 13, then that's only 4 points there. So then if you do, what is it here? You save yourself from losing another $80, say $80 per contract, okay? If you had your stops resting right here at the back end. But again, this video is about cutting the loss early enough to prevent yourself from taking a full hit on your stop. So if the market's starting to move back in your direction, and an example here on a supply setup moving short, we get the break and close. Maybe you're in an 804, 803, and then the market moves, breaks here, second candle. If it turns back around and breaks above that first candle, you have to make a choice. Do you want to get out right there or wait to see if it's going to start to break slightly above the second candle back up to the upside here, right here at 809? If it does that, then you may want to close the trade and prevent yourself from losing that additional $80 per contract right there. Or if you had it resting back up here at 15, that $120 per contract. So this is just a way. Now, again, that's trading at the E-mini NASDAQ, not the micro. But this is just a way to save yourself or protect your funds, your capital, and cut the loss trading futures early enough. So I just want to share that with you, okay? But outside of that, that's really all I wanted to talk about today. If you're a first-time viewer here to the channel, this is kind of going over just a simple rundown of the strategy itself, but more so how to cut the loss early enough without it hitting your full stop. So if you don't mind and you're not a current subscriber, go ahead and click on that sub button now down below. Make sure to turn on your post notifications by clicking on the bell so that you never miss one of the uploads. To anyone out there that's interested in joining the Discord community, it is free. The link is down in the description portion of the video, the first link you find there. The second link you see where it says become an elite member, if you choose to want to do so, that's where you get the trade breakdowns, trades that I post over on the Discord that I've actually taken myself. I go into great detail about where to place your stop loss, profit targets, going in detail about the trades themselves using the strategy. So it has helped lots of individuals that are part of the Discord as well, and people that I appreciate each one of you that subscribes to be an elite member. Thank you for doing so, because you're supporting my efforts as a content creator, and that's one of the kickbacks or rewards or perks that I give back, okay? So if you're interested in becoming an elite member, that link is right below the Discord link down in the description. Outside of that, if you found value in today's video, please make sure to drop a like on the video and see everyone in the next one. Have a great rest of your weekend.